So will Powell give the markets what it wants, or will he try to take the focus off of rate cuts? Our next guest thinks the latter in her new piece titled The Jackson 5. Joining me now is Sarah House, Wells Fargo senior economist. Sarah, it's great to have you on. Welcome.
Thanks, Morgan, for having me.
So what do you think? We have a lot more data here and it's not decided?
We do. So we have, of course, another month of inflation data and, of course, another jobs report. And so I think when we hear Powell tomorrow, I think he's going to be reluctant to pre-commit to any sort of move for September. I think he's going to keep that door open, understanding that the data could tilt in that direction. But I think he really wants to keep the committee's options open, in part because there is not a clear consensus among committee members. And so he can't speak for the committee in that regard.
So as you comb through the data, do you think a shift towards more focus on the labor market is warranted, given the fact that we've seen some softening there, or no, too soon to tell?
I think we are moving that way. So we've been concerned about the overall strength of the jobs market, where it still remains in balance if you're looking at things like the unemployment rate, the openings ratio per unemployed worker. But I think the loss of momentum in hiring, and especially that I don't think this is all just from merely slower growth in the labor supply coming from immigration. So if you look at the breadth of hiring, that's been extremely narrow, and we can't rely completely on healthcare hiring to buoy all employment. So I think we are a little bit more nervous about the overall strength of the jobs market, and that leads us to expect that our base case is still that we will get a September rate cut followed by 2 more 25 basis point cuts before the year is out. But it really hinges on that labor market continuing to show further loss of momentum.
Okay. You talk about the Jackson 5 in your note. What does that mean?
Right. So we are 5 years on from the Fed's last policy framework review. We know they're getting close to announcing the results of their latest review. So we saw that hinted at in the minutes. And so we're actually thinking that Powell's going to use his stage tomorrow to talk about these changes to the policy framework. So this is pretty much going to, we're pretty certain this is going to be his last as Fed chair. So using the stage to walk through his 8-year tenure, talk about how the macro environment has changed dramatically from where the Fed was concerned about the zero lower bound, persistently low inflation, to really the opposite. And so we think he's going to walk through why we need to have a more robust framework, focusing more on symmetry in terms of misses from both the inflation and labor market sides of its mandate, given just the wild ride we've been on over the past 5 years, where we're now in an environment where we're still worried about too high inflation.
Interesting. So would you say that marks a bit of a reversal then?
I think so. So in many ways, this quote new framework will look very much like the old framework, so the one prior to 2020, where the Fed was taking a more symmetric approach to its inflation target. So remember, we moved to flexible average inflation targeting with the 2020 framework, where the Fed was saying we're okay with overshoots if it's come after periods of undershoots, but not vice versa. Well, now we think they're going to move back to, look, we're aiming for 2%, as close to that as possible at any given point. We will let bygones be bygones. And then also just in terms of the jobs market. So with the reminder that you can have an overheated jobs market contribute to too high inflation, we think the Fed's going to move away from focusing on shortfalls for maximum employment and move back to that focus on deviations in either direction.
Okay. Should we be paying more attention to the Fed's balance sheet, especially given what we've been seeing in the bond market with Treasury yields and Treasury issuance?
Yeah, so I think the Fed is still looking to de-emphasize that as a tool. I think at some point the framework will need to address how the Fed uses that as a tool, where really it's been in many ways kind of a last-minute adjustment, as we saw in 2020. But I don't think that we'll hear much on that front tomorrow, as I think the Fed is really just kind of trying to keep that quiet. They're, of course, still letting assets mature and roll off, and so still looking to normalize that a bit further and not making that a focal point right now.
We've been talking about Powell as almost like the peak of the next couple of days in this symposium out in Jackson Hole, but we are hearing from a number of Fed speakers, including, we just mentioned Schmidt earlier, who is a voting member, a number of others to the next couple of days, and even some international central bank heads as well, like Christine Lagarde. How closely are you going to be monitoring all of those, since it really isn't just the Fed that investors are focused on with a potential rate cutting cycle, but also other central banks that have either made cuts of their own or poised to do so?
Right. So that's the beauty of the Jackson Hole Symposium. It's this gathering. It's a powerhouse in terms of central bankers and researchers. So while Powell will be the limelight, he'll get that central spot. But it really is more that you're going to hear from lots of different central bankers and also a lot of good research. So the focus this year is the labor market, and so figuring out how that's changing, and I think also inform how the Fed should be reading a lot of these labor market indicators, given the transition that the jobs market and our demographic population is going through right now.